and welcome to the 2023-24 Research Challenge. I'm really excited to have everybody here. We're going to be recording this entire thing, so at the end of this, I'll get that recording out to you in the next day or two. This meeting will take about an hour and a half. The first roughly half or a little bit less than half of it will be devoted to the presentation from Walmart, and then we'll talk more about some of the rules, presentation requirements, and so forth.
Yeah, I'll do that because it might be in there. I don't know where else it could be unless I just got lost.
Let's see if I can mute whoever that is. And but I didn't see a button to mute just yet, so I'll wait. And we can do it again later if it gets noisy. All right, so like I said, we'll cover the presentation from Walmart, and then you'll all have chances to ask questions. I'll ask primarily the students to ask questions, but professors can jump in as well at this point. And then I'll go over those rules, and we'll talk about how this entire research challenge is going to run over the next several months. And with that, let me open it up to Steph and Kirsten from Walmart. And we're very happy to have them from the investor relations team at Walmart. This is a really exciting time for us to be able to, for the students in Colorado and Wyoming, to be able to work on such a prominent and important company. And this will be a fun process for us. Steph, I'll let you take it from here.
All right. Thanks, Peter. And good afternoon, everyone. I want to start by just saying thank you for choosing Walmart to be the focus company of your research study this year. We're proud of what we have going on, and we're really excited to share it with you. We also want to make sure that you have a chance to ask us some questions. So I'm not a professor by training, but I've been told that I could have been a professor. So you're probably going to feel a little bit of that as we go through this presentation. I would love this to be interactive. So if you are on Zoom on your computer, maybe we'll use some of the Zoom functionality to raise your hand or signal if something is resonating with you. That way, Kirsten and I will know that we're making sense based on what we're sharing. So I'm going to start by sharing my screen. We put together just a really short presentation about who Walmart is. We assume that many of you know who Walmart is, but we're going to try to maybe share with you a little bit more about behind the scenes, what's happening at Walmart. We often talk about ourselves as a Fortune 1 company. You might hear things like Fortune 10 or Fortune 500. We're a Fortune 1. We're the largest company in the United States. So we'll start there. You are undertaking a research study on the biggest company. So let's start with who we are. We serve about 240 million customers every week around the world. We operate in about 17 countries. We have 10,500 locations. About 5,300 of those are in the US. And that's probably what you're most familiar with. If you were driving down a freeway and you were to see a Walmart sign, you might be seeing one of our Walmart supercenters or a Walmart neighborhood market. We serve, again, about 240 million customers worldwide, about 150 million customers a week in the US. And we have stores within 10 miles of 90% of the US population. So one of our key assets is our proximity to customers across the United States. Last year, in what we call fiscal 23, our fiscal year ends in January, we did $611 billion on a global basis. Our operating cash flow was just under $29 billion. And while we serve 240 million customers every week, we are actually also the largest employer. We have 2.1 million associates worldwide. Some of the things that we're known for within the investment community is that we have a very reputable credit rating, a AA credit rating. This is really important to us as we think about how we finance the growth of our business. But also, as a retailer, one of our single biggest cash uses is to buy inventory that we then resell to customers. And so that AA credit rating also gives us access to what we call the short-term commercial paper market. And that's how we use what we use to fund our inventory. We've had 50 years of consecutive dividend increases. We're what on Wall Street is known as a dividend aristocrat. And we have 12.7% return on investment. And that's something that we'll come back to in this presentation. It's something that we aspire to be higher, our return on investment. And jump forward. This is something that's new for us. We often get asked about, well, what is Walmart? How would you describe it? And so our CEO, about a year ago, when I had first joined the company, he challenged the head of IR and the head of corporate communications to sit down and come up with a very simple phrase. How do we describe who we are? We're a people-led, tech-powered, omni-channel retailer dedicated to helping people save money and live better. We're going to talk a little bit more about what that means, but I want to share with you the symbolism that's in this statement. It might seem very simple, but there are very, very significant word choices and word order. First and foremost, let's start with the second line, dedicated to helping people save money and live better. Our founder, Sam Walton, he was awarded a Congressional Medal of Honor. And in that speech, he talked about helping people save money and live better. So those words are directly from our founder. And Kirsten can attest to this as well, but you walk around our home office and there are signs of what we call Mr. Sam all over the place. And I've been in meetings over the course of the last year at the company, and there is an empty chair in the room oftentimes, and you'll hear the voice of Sam Walton coming through the conversation. So it's very rare to have an organization that's 60 plus years old that still has a very strong voice from the founder. One of the reasons that comes to life in our governance is that 3 members of the Walton family occupy seats on our board of directors, including Sam Walton's son, Rob Walton, Sam Walton's grandson, Stuart Walton, and what would be Rob's son-in-law, a man by the name of Greg Penner, who you might know if you keep track of Denver local news. Greg and his wife, who would be Sam Walton's granddaughter, bought the Denver Broncos. And so Greg spends a disproportionate amount of time in Colorado. But this was a very important thing for us to symbolize and to recognize and to honor our founder in our positioning statement. And it couldn't be more true at any point than it is today, helping people save money and live better. The top line of this statement is how we're evolving, how we're changing. One of the things that's been true about our business from day one is that we're people-led. And it's very important how we identify our people are our biggest advantage. And we all say internally, our people make the difference. Tech-powered is something that's becoming more prominent, especially for how customers engage with us. Customers are shopping us online, in-store, within store, on their mobile device. This idea of shopping anywhere, anytime is what omni-channel stands for, but a lot of that is powered by technology. And we mentioned earlier that we have 2.1 million associates worldwide. We're increasingly equipping them with technology to help them be more productive and efficient as well. And then the last word on that top sentence is, or top line, is really important. We want to identify authentically with who we are. And that's that we're a retailer. We're not an e-commerce company. We're not a distributor. We're not a manufacturer. We do a lot of those things, but at our soul, we're a retailer. A retailer buys goods and sells them to customers. And so we wanted to embrace that notion of what our role is in the broader consumer ecosystem. Just double clicking on a few of these things, when we talk about how this comes to life inside our company and outside of our company, this is what it means. So we talked a little bit about people-led, and our people are the difference. But this means that we also have to actively live out our values and provide opportunity for associates to grow and to belong. And you might hear a lot about things like DE&I, or what's now becoming more of a known term called belonging. We have a new chief belonging officer that we just hired. But we really want people to come to work every day and be their authentic selves, but also feel like they matter and they belong. And so workplace environments are changing, certainly as we come back from the pandemic, and there's in-office time and out-of-office time. But this idea of belonging is something that we're really embracing as a corporate culture. As I talked about earlier, tech-powered. This also gets into delightful experiences, intelligent operations. We'll talk a little bit about that later. And then enabling the future through innovation. One of the things that we know about our role is as a $600 billion company, that we are the ones that are going to have to pilot innovation. If we don't invest behind innovation in certain areas, it may never get off the ground. And so we, and alongside other companies like Amazon, we're going to be leaders in innovation and experimentation in order to get some of the future technologies that we're going to need off the ground so that we can grow and scale. And then omnichannel, I mentioned earlier, kind of when customers want things, how they want them, we need to be entirely flexible and agile to address our customer needs at any point and in whatever way they want them. And that's one of the benefits of being what we call a broad lines retailer. We sell grocery and consumables goods, which account for about 65% of our sales, but 35% of our sales are in discretionary categories like home, apparel, electronics, kitchen goods, furnishings, furniture, larger electronics. So you'll see us selling things across that range of goods, and that provides us some diversified hedges within a business when certain categories are performing better than others. And we talked a little bit about save money. That's our commitment to what we call ED low P, everyday low price. That's a term you'll hear a lot at Walmart. We have an everyday low price, everyday low cost mindset. And so we want to make sure that when we save money, we're passing that along to our customers. And then Live Better is an area that we're building out and making some investments in areas like time savings. So if you want to pick up something curbside or you want to have it delivered to your home, we're expanding capacity there. We're investing in health services. We want to be able to connect health services to pharmacy, to over-the-counter products, and even into your nutritional areas, thinking about health in a holistic way. Financial tools is something that you might see if you show up at a Walmart store. You can cash a check, you can remit capital. We have the ability to cash a check in the United States and send that money to a family member in Mexico. And we have a lot of customers that do that. And then we also want to strengthen our people, communities, and the planet. And that's where you'll see some of our efforts around sustainability. If that's something that you're interested in focusing on, we have an entire encyclopedia of information out on our sustainability site. Our sustainability team is a very, very large team, focuses on a lot of different areas, and they write briefs, almost like legal briefs, across various disciplines and areas. And so there's tons and tons of information out there. I would encourage you to navigate out to our website and find that. All right, let's jump into a little bit of the financial model. So as you're thinking about putting together your project, this is going to be the financial foundation in which we think about generating returns for our shareholders or generating appreciation. The first is growth. We need to grow our top line. So just to put this in perspective, if we are to grow on target with our growth algorithm of 4% top line on top of a roughly $600 billion business, we need to generate about $24 to $25 billion of growth every year on a global basis. So we are creating a Fortune 50 company inside of our company every year. So just thinking about that in sheer size. That growth needs to be high quality growth, meaning it needs to accrete to our margin profile. So we're going to improve our operating margins through productivity. And we'll talk about that as it relates to automation, through improvement in our mix of business. And that's something that we're also developing is how do we use our retail foundation and layer new businesses on top of it, such as advertising, marketplace, fulfillment services, membership, and data services. Those businesses grow at a much higher rate and they have structurally higher margins. And returns, we want to improve our return on invested capital, and that's going to come through the numerator and the denominator. Margin improvement, which is the numerator. And then we want to be disciplined with our capital. We want to lower our capital costs and we want to increase our capital returns. And so that discipline means that every dollar of investment inside of Walmart fights for the highest rate of return. All right, you can think of our business, and our CEO likes to describe it this way, in two P&Ls. The first is our stores and our first-party e-commerce business. So this is based on the inventory that we fully own. And the measures within this P&L are pretty traditional P&L measures: sales, gross profit margin, SG&A costs, and operating income. We have highly profitable stores today. They're subsidizing what today is a loss-making, nearly $100 billion e-commerce business. So our business in e-commerce is about $100 billion. It's not making any money. So that means our stores are paying for that loss. We are working very hard to close those losses, to eliminate those losses, and to turn our e-commerce business on a first-party basis into a profitable business. And we're not that far away. So showing some progress on that, and Wall Street has really found favor in that directional progress. We've had rapid growth of what we call OPD. That stands for online pickup and delivery. More than half of our e-commerce business is executed through online pickup and delivery from our stores. So this goes back to that positioning statement that we talked about earlier. This is why we think the future of retail is omni-channel. We're doing more than $50 billion a year where people are coming to our stores and picking up their orders, or where we are delivering from a store to a door. And that's where that proximity advantage comes back into play. It's much easier to develop profitable last mile e-commerce sales when you have stores, or what we think of as distribution hubs, within 10 miles of 90% of addresses. We also have 2 other businesses within our portfolio, Sam's Club, which you might recognize if you're a shopper within the membership model space. There's Costco, there's Sam's, there's also BJ's. We're the second largest within that group. And we also have a large international portfolio, and we operate in countries including China, India, South Africa, Canada, Mexico, and Central America. And I mentioned earlier supply chain and automation. So this is an area where we're investing capital within our balance sheet to retrofit our distribution centers to be less manual and more automated. And this is in areas of automated storage and retrieval, robotics, sensors. You can think about this as like unmanned vehicles or robotic-driven vehicles. So we're able to stand up more capacity in less space with less cost. So what do we need to do within this first P&L to achieve our financial goals? Well, number one, we need to execute our profitable growth strategy. And that means growing businesses that within our first party network and our stores that are delivering accretive growth. The second is that we are also going through a US remodel program, and a number of you might have been to a remodeled Walmart store, but we're going to touch about 700 of our nearly 5,000 stores this year. And we're going to do 700 a year, or even potentially more over the next several years. And this is based on the realization that we need to make sure that our store environment is exciting to shop and people want to commit the time to shop in a Walmart store. And then the last piece on this first P&L is density for delivery. We need to deliver to more houses. Today, we have a very large e-commerce business, but we're not delivering to a lot of households. And so growing our e-commerce business through incremental household acquisition is part of our strategy to build density. On the second P&L, and this is the more attractive P&L because these are businesses that are more fee-based, higher margins, higher growth areas. And we call this P&L, it's driven by what's called GMV, gross merchandise value. And this is a term that you might hear if you were studying an e-commerce company or a digitally native company. That GMV value aggregates up to revenue value, the total amount of merchandise value that's being sold. That's important for our third-party marketplace business. So today, when we sell an item for a marketplace seller, we take a cut of that sale. We don't record the wholesale. In our first-party P&L, we record the wholesale, the entire amount in our P&L. So these businesses that are fee-based, they don't have a big cost structure behind them. So the structural margins of things like advertising, membership, marketplace fees can be 60 to 80%. Relative to our first P&L that you see on the left, where our margins are 5%. So the distortion in margin is pretty dramatic as you start to stand up the second P&L. And the growth of this second P&L right now is tracking north of 35%. Our core P&L is growing anywhere between 4 and 5%. So higher growth and higher structural margins. So what do we need to do to achieve our financial objectives in the second P&L? We need to expand and retain members. So as we grow our membership or our number of customers that are using us on a highly recurring basis, we need to increase our sellers and our brands that we're listing on our marketplace. And one of the things I would encourage you to do as you're studying our companies to go out and shop a little bit on our website. You might be surprised at the number of brands that are listing on our marketplace because of the growth in traffic that we're seeing on our website. Brands like Dyson, Callaway, Frigidaire, Levi's. We're getting a number of brands that historically you would have found at mid and maybe upper mid-tier department stores. They're coming to us now and saying, we know that traffic is moving towards you. We want to be where the traffic is. And so they're listing on our marketplace as a seller. We also need clean and comprehensive data. And we'll come back to this as we think about new data methodologies and tools like AI and generative AI. We have a very, very robust set of data. Again, 250 million customers a week. That's a lot of data points across millions and millions and millions of transactions. So we can learn a lot about customer behavior, customer sentiment, And we can use that data on a clean and comprehensive way to build better strategies for ourselves, but also for our sellers and our suppliers that work with us. All right, we talked a little bit about this, but let's dive deeper into some of these alternative value streams. When we engage with investors, they want to spend a disproportionate amount of their time on this specifically, because this is the power driver that bends the EBIT curve up. That's what that arrow behind these images represents. We want to drive incremental profitability to our company. Another way you can look at that is through a measure called incremental margins, or incremental profitability per dollar of sale. It's a measure we look at pretty consistently internally. So we talked about advertising, but let's share a little bit more about what we're saying with advertising. So we have about a $3 billion advertising business. It's growing again at a rate north of 30%. And what we've done is we've effectively stood up an ad business inside of our company. And this ad business we sell to our suppliers, which are companies like Procter & Gamble and Pepsi, Coca-Cola. We're typically, for most companies, their largest retailer. And so we're building pathways for them to directly address customers through advertising. We're focused on what's called healthy ROAS, return on advertising spend. So just like we're trying to drive our return on investment, advertising buyers are trying to drive return on their investment. And we want to make $1 of investment in Walmart's advertising platform better than the return that you can get anywhere else, whether that's on social media, in search, broadcast, radio, outdoor, event sponsorship, influencers. We look at all of those alternative forms of media and ad building, and we're building an economic model internally that's superior to those other alternatives. One of the ways in which we do that is that we have very strong attribution. We can serve a customer cohort, let's call that 10 million customers, can receive an ad, and we can attribute the purchasing of that product in store or online. So relative to a digital only or physical only retailer, we can connect the two different channels, digital and physical. And we also are driving superior retention. And retention in the advertising industry means how much ad value still exists many weeks after you've launched that ad. And most ads, and this is why the ad industry is so big, most ads by week 12, 13, 14 have almost no value left, which is why the advertising industry has to go out and reacquire its customer every 12 to 14 weeks. Within our model, retention is in the double digits after 14 weeks. So more than 10% of customers that saw the ad are still buying the product that much later. On membership, this is our W Plus and our Sam's Club membership business. So one of the ways we drive engagement and personalization is to build a membership model. And this is a paid for model. With your membership, of course, you get free shipping, just like you would in an Amazon Prime or any other membership platform. But we're also using this to create very robust feedback loops within our business. And we do believe in this idea of co-creation with our customers. So we're constantly dialoguing with our customers. And in the Sam's Club business, this is what they would call their member. And they're constantly dialoguing with their member, getting feedback. And within their Sam's Club's private brand called Members Mark, they test product with their members prior to launching it. So they have a very, very high hit rate of successful products because they've done all of the work to build a great product, knowing what their customers or members are looking for, and then testing that product with their members before they launch it nationwide. Marketplace, we talked a little bit earlier. This is effectively the ability to list product on our website, product that we don't own. So it's a digital real estate platform, and we collect fees and commissions from those listings. And then we also grow our sellers and our brands. And that's important for our customers. We want Walmart to be the destination for shopping. And when we can expand the number of brands that we offer, that helps our customers find what they're looking for. Today, we have about 400 million items on our website, 200 million items in apparel, and 60 million items in home. So one of the things we can talk about in the Q&A, if you would like, is why do we have 260 million out of 400 million in apparel and home? Well, the clue is that those two categories have a very, very high trend index. Everybody has a slightly different preference and opinion, so you need a lot of choices in order to satisfy a lot of customers. Fulfillment is where we effectively have built this robust network, and we'll talk a little bit about that later in terms of our supply chain, but we have trucks and trains and ships moving all over the world. And we can do so at a low cost, which is why we're able to offer everyday low price to our customers. And we know that that fulfillment is a business that we can enable other companies to hop on our rails, or what we call ride our rails, for a lower cost than what they would pay another smaller third-party logistics company. So we're seeing more and more companies come to us to be their fulfillment provider because they know we already have rails or wheels moving around different markets of the world. And that gives them the ability to reach customers alongside us. The last piece is what we call Walmart Data Ventures. I talked a little bit about this earlier. With 240 million customers a week, we've got a lot of data. And we're just in the very early innings of using that proprietary data. As you can imagine, there are a lot of rules and regulations around customer data, and we're very, very honoring of those rules and regulations. So we are very careful. The good news is that for Walmart, because our customer base is so large, for anything to be meaningful, it needs to be about 10 million customers. So it'd be very difficult to get down to the individual customer level in any of our data because it's just not meaningful within a customer base of our size. But we are starting to use this data to create packages and tools for external partners. That might mean our suppliers, our sellers, but it also might mean communities that we're partnering with. And one of the ways that we're doing this right now is that we are launching into a community solar project, and we're investing in EV stations. Well, part of that comes with the proprietary data of understanding how our customers move and where it might be most beneficial for them to power up their vehicles with an electronic vehicle powering station, most likely right in our parking lots. So you're going to see some investment behind connecting data to opportunities for our customers. All right, let's dive into an area that's attracting some attention. And I'll put some numbers behind this for you. So on an average year, Walmart in the past would spend anywhere between $12 and $13 billion on capital expenditures. So this is now off the P&L, and it's in the cash flow statement and the balance sheet. And we've taken that number up to 18 billion or even possibly more. And part of that is a very significant investment over a 5-year period in our supply chain, moving from a heavily manual operation, and that's where a very large percentage of our 2.1 million associates were focused, was in our supply chain, and we're moving more towards automation. So you can see the pictures on this screen where you have a robotic arm that's building packages and pallets headed to our stores. And in the US, just for relative appreciation, we move over 100 billion items a year through our system. So there's a lot of inventory and a lot of product that's moving through our system. And so robotics and automation, especially automated storage and retrieval, improves accuracy and lowers cost, and also lowers risk related to that inventory movement. What it's also done has actually been a net positive for our customers and our associates. Customers are getting what they want when they want it. Inventory is available where they need it, but our associates are no longer spending time doing heavily manual tasks. They're spending more time using their minds, and they're running the woman in the bottom is a cell operator. She's effectively an engineer, and she's managing data and processes to ensure that those totes and those pallets going to our stores are on the most accurate pathway. And she's using analytics, and she's being upskilled to do that. So she's no longer walking anywhere between 12 and 14 miles a day and lifting thousands of pounds of goods. She gets to use her mind. And what we're finding is that our employee retention numbers are going up, and our employee satisfaction numbers, or what we call eNPS, is going up. So by the end of fiscal 26, we're in fiscal 24 right now, so that's a couple of years away. Approximately 55% of our fulfillment center volume will move through automated facilities, and we are able to lower our unit cost average by 20%. So for a company of our size to reduce costs by 20%, we're talking about billions of dollars of savings that we are going to pass through to our customers and to our shareholders. Let's talk a little bit about our supply chain. So if you were having this conversation right now with a very modern e-commerce driven company, they would talk about distribution centers that maybe were 10 or 12 years old. You have to remember our company's been around over 60 years, and it started as a general merchandise retailer. And so what has happened is that we have built different fulfillment pathways or supply chains for different parts of our business over time. And now we're putting them together like a puzzle. So suppliers and sellers sell to us, and we have different pathways that could go through an e-commerce center or a fulfillment center. It could go through an ambient distribution center, which is things that don't require temperature control, or it could go through a perishable food distribution center, just things that would need refrigeration or frozen food, for example. So getting those all in line and getting all of the data to talk to each other to make sure we're optimizing is the phase of development that we're in, alongside retrofitting our perishable, ambient, and fulfillment centers to be automated. So there's a lot of motion happening in this area of our business right now. And our CEO, Doug McMillan, who's been in seat for about 10 years, he's been at the company for over 30 years. And he gets so excited when he gets to talk about this part of our business, because he has been waiting for almost 20 years for this to become a reality. And we've actually been in testing for our current solution for over 7 years. We needed the right kinds of robotics, the right kinds of data systems, the right kinds of physical operations, the ability to do it at cost. All of that needed to come together to unlock this opportunity to modernize what have been decades old supply chains. And so this is a really exciting part of our story, and we've got a great team that's leading this. Last April, we took a group of investors to one of our ambient distribution centers, and I had to pull investors away from the robots. They were so excited to watch them. And that's not something we get to do a lot in retail, is take people into our distribution centers. But we were really pleased with how many investors were asking, how fast can you do this? Can you do it faster? Because this is going to save you a lot of money, and it's going to improve your inventory efficiency and your quality significantly, which is a benefit to your customer. So a lot of capital investment is going into this agenda and strategy right now. Again, about $6 billion a year of a step up relative to our historic average. We're also renovating our stores. So this is another thing that you'll see, and I mentioned this earlier. You might have gone into a renovated Walmart store, and you'll see some pretty significant visual merchandising changes. So we recognize that in order for customers to devote time to come into a physical retail destination, it needs to be worth their time. And so we're making some strategic changes in how we visually merchandise some of our core trend areas, including apparel that you see there on the left, home, baby, beauty, and pets. These are all emotive-driven categories where emotion drives just as much of the purchase as logic. You'll see things like enhanced lighting. We're installing digital screens. We've got kiosks or these little setups, brand shops, upgraded fixtures. There's a lot more to come behind this, but I think you should look at this and say, this is a pretty big step forward for Walmart. Or like our CFO likes to say, he stepped into one of these stores and he said out loud, this isn't your grandfather's Walmart. It feels different, it looks different, and we hope that the experience is different. In the stores where we've made these remodels, we're seeing store sales uplifts near 20%. So very attractive return on the capital that we're spending, and we're seeing immediate benefits. Our CEO of Walmart US also revealed recently in a meeting that we're seeing what was called a halo effect. We can upgrade 1 or 2 stores in a market, and we see 7 or 8 other stores in that market also see a sales lift. So overall, really pleased with the feedback we're getting from our customers, our associates, and our suppliers on some of these remodels. Sam's Club, I mentioned that earlier, that's part of our portfolio. We are expanding their footprint. So Sam's Club has actually been in a store contraction and store stability or club stability environment for several years. They went through and cleaned up the portfolio in the US of clubs, and we're now actually in a position to start opening clubs. I'm going to try to open about 35 clubs over the next few years. And Sam's Club is also investing in automation in their business, particularly for their e-commerce business, which has been growing strongly double digits. And so that is one unique attribute of Sam's Club relative to other clubs in the membership model space. Sam's has a very robust and rapidly growing e-commerce and digital connected business. We see it in club, and we also see it online. And then Walmart International is the last piece. We talked about the markets that we compete in. 19 countries, actually I truncated that earlier. So we added a couple more countries in Central America, but 500,000 associates and about 80 million customers per week. So a pretty big business. All right, I'm at slide 12. And does anybody have any questions so far? Otherwise, we'll keep flowing.
Yeah, please jump in if you have any questions. It's fine to take a break and ask a few questions about what we've covered already.
Hi,
Right. Go ahead.
All right, yeah, so this is Cassie Lau. I'm one of the faculty advisors. This might be slightly off the topic, but are you seeing a lot more shrinkage in your business? Please, thank you.
Yeah, so we have seen an increase in shrink, but not at the level that's unmanageable for us. So you might be hearing a lot of retailers talking about theft in their stores, and there are fortunate and unfortunate consequences of what you see in the media. What you see typically are these big flash mobs, people running in with ski masks on and grabbing a bunch of merchandise and running out the front door. That's not the bulk of shrink. The bulk of shrink is actually far more sophisticated than that. But that's what's getting a lot of the attention. We have seen a step up. I would say one thing that probably provides a bit of defense for us is our product mix. 65% of our products is food and consumables. So it's not nearly as exposed to companies like an Ulta or a Macy's where they have high priced, high value goods. But one thing we are working alongside our partners with are two areas, actually. One is legislation and law enforcement, and trying to make sure that in certain regions, we can see the prosecutorial standards improved. In some markets, you can steal thousands of dollars of goods and not have any penalty. And we have videos of people, stealing right up to 1 penny below, walking out the front door, holding up their phone camera or their phone with the phone calculator with an amount on it. And we can call the authorities, they can come, they can ask us to tally it all up. And if it's below the threshold, they say to the people, have a nice night. And so that breeds bad behavior to begin with. The other thing we're working with our partners, our retail peers on, is we have a large and growing marketplace business. And some of the theft is a result of the ability to resell this product on marketplaces. So we're doing a lot more tracing. And you might have seen recently some headlines around Home Depot just had a big crackdown on this. We were part of that, where we were able to identify that goods were being redirected. And some of that is coming through things like RFID tagging, where we can identify that it's been stolen, and we can trace it. And then we can work together with retail partners to identify those rings or individuals that are propagating those crimes. And those tend to be cross-border, cross state lines. And so that's where it gets to be much more of a federal crime. But it takes a lot of collaboration, takes a lot of coordination. And I wouldn't even tell you that it's a US only phenomenon. We're seeing it in other markets of the world as well, which is slightly disturbing in terms of kind of the overall moral compass of the world. But so it's not only just a US phenomenon. We did have a conversation recently with an economist that provided an additional perspective, which said that as consumers get stressed, you tend to see behaviors like this increase. That could very well be the case as well.
Thank you very much.
Yeah.
Thank you, Cassie.
All right, well, let's jump into the next few slides and then we can open it up for questions again. One of the things I wanted to just take a moment to recognize is that we've changed our international portfolio quite a bit. So if you were to go back even 10 years ago in Walmart's history, you would have seen a different complexion of our international portfolio. It was very much a cash flow focused portfolio, slow growth, high cash flow businesses in markets like the UK, Japan. And what we've done is over the course of some acquisitions and some divestitures, we've reshaped that portfolio to be much more about growth. So when you look at markets like China, India, we own Flipkart and PhonePe. Those are markets that are growing strongly double digits on a compounded basis. Walmex is our Mexican business. It's actually publicly listed in Mexico, so you can track it very closely. But Walmex is a high single digit growing business. Canada, Massmart, those are more mid-single digit growing businesses. So when you blend it all together, you're getting this high single, low double digit growth portfolio within our overall enterprise. And that's very important as we think about driving the top line growth of our company. Our international portfolio is going to contribute about 1 percentage point of enterprise growth every year to our overall company. So it's a fairly meaningful growth driver of the business. And it also provides us some international market exposure in places like China, where our business today is roughly 50% online, 50% in store. So a little bit of a snapshot of what the US could look like not too far from now. Flipkart is a marketplace business. So that's giving us some very distinct advantages into the insights of scaling a marketplace. And Flipkart's business is quite large. They're the largest marketplace in India. And PhonePe is a financial services platform, almost like PayPal. And interestingly enough, PhonePe transacts almost $1.5 trillion dollar equivalent a year of transaction value. It is actually larger than PayPal. And PhonePe accounts for about 1/3 of India's GDP. So if you think about a tiny little company that sits inside of Walmart, it's responsible for the transactions, the digital transference of payments for about 1/3 of India's economy. And PhonePe actually is designed to sit on top of India's banking system. So they have a public banking system. PhonePe is designed to kind of sit right on top of it. So from a regulatory and controls perspective, the government manages all of that. Our job is just to build the technology that drives the most utility in terms of digital cash conversion and cash flow. So it's been great. These are both great businesses. All right. So I want to talk a little bit about if you're to build a model for Walmart over the last 5 years and maybe project it out over the next 5 years, what you're going to notice is that we've had about 6% annual sales growth. This is from fiscal 18 to fiscal 23. So this is up to the year ending in January of 2023. But our operating income has only grown 3%. And the question is why? What happened? Why did we not accrete more profitability growth as we've grown sales? And part of that was that we needed to invest in 4 areas. One area was price. And coming out of the global financial crisis, Walmart's pricing architecture had gotten out of sync. And so we needed to make a step function investment in price. We've done that. Our price gaps relative to the competition now are very healthy. We're actually gaining market share. And our price value proposition to the customer is very clear. So check that box. We don't expect to have to make discrete investments in price over the course of the next 5 years. Wages was another area, and I'm sure you've all seen wage inflation numbers. We've had about a 65% increase in our average wage over the course of the last 5 years. Well, obviously, our business growing 6% top line means that we haven't had 65% revenue growth. So we've been delevering in wage growth. As we think about our employee population and wages over the course of the next 5 years, we would expect some wage inflation, but certainly not at the same level that we've had over the last 5 years. But we also talked about automation, and we're replacing some of the manual roles, especially areas where we have high turnover and low employee satisfaction, with automation. So our employee population, which we talked about at the beginning, 2.1 million associates today, in 5 years, we could have 2.1 million associates. There may not be any change in our total associate population. However, we'll be about $130 billion more in revenue. So all of our growth in revenue is coming on top of the same or stable population of associates with a minor level of wage inflation, more, I would say, industry indexed wage inflation versus leading the industry. We talked about e-commerce losses, so that's been a burden on the overall P&L. And we've had some step function in tech investment, and that's been in areas related to our digital business, but also in the startup costs for some of those second P&L businesses. We've started up an advertising company inside of our company, a marketplace company, a data company, a membership business. So there's tech related to the standing up of those businesses, almost like startup costs for a technology company have been inside of our P&L. So that's been about 0.5 point of a burden on the disparity between sales growth and operating income growth. The good news is that over the last couple of years in the pandemic period, we have grown revenue a little bit faster, and we've grown our operating income a little bit faster as well. And we're working really hard to invert that. And so far this year, we have. So what we'd like to say from a positioning perspective is, you know who we are. We talked about that earlier. We're a people-led, tech-powered omni-channel retailer, helping people save money and live better. But our unique competitive advantages and the investments we made, we think position Walmart to drive strong growth and shareholder returns. And so we like the position that we're in. And what you're going to see from us over the course of the next 5 years is that we expect our sales to grow roughly 4% and our operating income to grow anywhere between 4 and 8%. So we have a very ambitious profit outgrowing sales financial framework. And we're increasingly confident we can achieve this. In the first half of this year, we grew sales 6% and we grew operating income 12%. And we expect this year on a full year basis to outgrow sales with operating income. So you'll continue to see us leaning into this financial framework. We don't call it an algorithm so much as we think about it as an overall framework with operating income growing faster than sales. And that's going to lead to a very important inflection in our returns. Anytime you have profits growing faster than sales on the numerator, and you have a denominator where your cash conversion is improving and your overall cash utilization is improving, you have a disciplined capital approach, you should start to see return on investment increase. And our business has a history of having much, much higher returns. You can see that back in 2007, 8, 9, we were in the high teens in terms of returns. That was a pretty stable level for us. So you might step back and go, well, what happened between 2011 and 2021, that 10-year period? We introduced e-commerce into the business. And so that is the degradation of returns from standing up an e-commerce company. And if you were to plot Amazon's returns next to this, you would see that they had ran their business at a loss. Actually, they're still running their business at a loss. But they had other businesses like web services and high fee-based service models that help them inflect that ROI trajectory. So we're in a very similar position to that. We're starting to look a little bit more in that second P&L like a tech company on top of a core foundational retail company. Talked a little bit about CapEx, but we are talking about our anticipated CapEx spend over the course of the next several years is going to be disproportionately tied to e-commerce, supply chain, and stores. And we looked through that together, supply chain and stores in particular. E-commerce is something that will continue to get some investment as well. And then the remainder of CapEx is more maintenance CapEx and some sustainability CapEx as well. Oops, all right. I think that's good. We have a couple of dump slides in the back, so we should be in good shape. I'm going to go back to the top of this, and we can also send this out, Peter, so everyone has it as a resource. Kirsten, why don't you make a note? We can do that together after this.
Great, thank you.
We'll open it up for any questions that you might have.
Do you mind if I ask you if you have any resources or anything you can point us to that would provide additional information about your firm, places where you can look, your vendors and partners as well?
Yeah, so let's do this. If you're okay with it, Peter, is it okay if I share screen and I go to the web?
Absolutely.
All right, let's do that. So a great place to start is on our investor relations website. And this is located at stock.walmart.com. If you go to that website, you will find a wealth of information, everything from our quarterly earnings to our annual reports. You'll see some proxy statement, ESG reporting, some of our diversity statistics. They're all found in our investor relations site.
This might take a minute to pull up. Right now I'm still seeing the RIs at an inflection point.
Oh, hold on a second. Let me restart that. Thank you, Peter, for calling that out.
You're welcome.
Just give me a nod if you can see it. Maybe I'll close this other one out and see if that helps.
Still ROI.
Still ROI. Okay, we're going to try to override. This might be a security issue.
Yeah, Steph, I was gonna say I can see the IR page.
You can.
So I'm not sure
Okay.
about others.
That might be a security precaution. Okay, so maybe what I would direct you to do is if you're on a laptop or you're tuning in via PC, you can go to stock.walmart.com and that will be a great starting resource for anything really about our company. The news flow that we have, our purpose. We have an investor section on our homepage. And you can read more about our suppliers as well on those sites. I apologize. I thought we would be able to share our web view. But stock.walmart.com is your best place to start for resources.
That's great. That's good enough. It's a good start.
Yeah. Any other
And
questions?
then is we were talking about a partner company as well when Jeremy and you and I were talking.
Yeah, we showed you a couple of pictures, but as you're out digging around about Walmart and our supply chain investments, you might come across a company by the name of Symbotic, and it's spelled Symbotic. Symbotic. Symbotic is a now public company. They went public last year through a SPAC, and you can read about them in their public filings, but they are our largest robotics partner. And we actually invested in them ourselves. I mentioned earlier that we've been working on some of this robotics technology in a proprietary way for about 7 years. They were our co-development partner. And so we have a time-based agreement with them that they can't go out and sell the technology to competitors of ours for a certain period of time. And they are helping us retrofit 42 of our distribution facilities. If you'd like to see a video of what that looks like, you can go to Symbotic's website. It's symbotic.com. And on their investor relations site, they have a full video of one of our distribution centers. So you can kind of see the technology that they've built, you know, again, with our help, using our data and our spaces and our inventory models. And together, you know, we've been able to build this solution that's highly customized. But ultimately, we want Symbotic to become a profitable, exceptionally valuable company because we own 10% of it. And so it would be limiting for us to just hold that in that proprietary technology back. And so they're already starting to work beyond our timeline to secure contracts for the automation of other facilities as well with other retailers.
Thank you.
Mm-hmm.
Now I'm going to open up to everybody else. I'll let you ask some questions. We will probably have about 10 to 15 minutes. So we'll figure that out as we go along. And feel free to jump in, either unmute yourself and ask the question, or if you need to chat with me, you can do that too. I'm gonna, yeah, go ahead.
Peter, Andy Sherbo.
Hi, Eddie.
Hi, good. The question I had was, thanks, Peter. I'm one of the coaches, but I was looking at your working capital, and it's always running a deficit.
Mm-hmm.
Right now, it's about 10 billion or so, I guess, plus or minus. Why is that the case?
Yeah, good question, Andy. And it's actually gotten worse the last few years. So
Yes, it has.
let me give you an explanation for that. So as large as we are and as powerful as we are as the largest retailer for the vast majority of our suppliers, we try to also be the nicest. And during the pandemic period, we relaxed the vast majority of our terms for our suppliers. So we were, for a period of time, for almost 9 months, we were paying for inventory before we sold it, which is inverse of what retailers should be doing to manage working capital the most efficiently. So we are in the process of tightening back up our terms to go back to normal operating conditions. If you think about 20 and 2021, we were just desperate to get inventory. Do you remember those days when people were running in stores and just buying as many paper towels and boxes of toilet paper as you could find? We needed inventory to satisfy demand. So we eliminated penalties and time targets, and we just were willing to pay for it to get it. Then in 2021, as inventory started to come back and the flow started to improve, our fill rates were still well below average. So most of our stores will function at about 95% filled. So 5% means you're still missing opportunity. But we still had a number of suppliers in 2021 that were only filling at 60, 70%. And typically that would result in a penalty. And we were not applying any of the penalties. Then in 22, last year, the supply chain went all wonky for everybody. And so Christmas inventory was coming in May and spring inventory was delayed until October. And so we again kicked the can and said, we're not going to apply any penalties until the supply chain works itself out. And these were the headlines that you might all remember about the boats all lined up outside of the Long Beach ports. And people were out there with binoculars every day counting to see how many boats still have to unload. We're through all of that now. And we've had pretty normal operating conditions for about the last 12 months. So supply chain fluidity is back. We get access to the goods we need. The fill rates are in place. but we hadn't yet brought our terms back in line. So it's a couple $1 billion of opportunity for us in cash flow, just to improve our working capital to get back to 17, 18, 19 type standards. So our merchants are doing the hard work right now, but boy, we were funding a lot of other people's balance sheets. That didn't feel so good.
Steph, this deficit goes back well before the pandemic. I'm going back to 2013, 2014, 2015. So,
Yeah.
I mean, it just seems every year you're running a huge deficit long before the pandemic.
Yeah, the deficit will always be in place because of what we do. We're a retailer, right? So the biggest amount of capital outlay every year is or cash outlays and inventory. So you're always going to run a net negative cash balance relative to inventory. $600 billion business, and 75% of that is in inventory cost. So,
Target would also show the same story.
Well, they may not have the same inventory fluidity because ours is 65% food and consumables and theirs is only 20%. But yes, they should also have far less cash than they have inventory on hand. Every retailer should look that way. Mm-hmm.
Thank you. Thank you. Thanks, Steph.
I'm going to go back to your main or your primary P&L and talking about the margins. This is a very, very normal question, a very typical question, even though you're not getting a lot of these questions anymore because everybody's talking about the expanded P&L.
That's
and
right.
all the new things. But looking at groceries versus general merchandise like clothing, home, beauty, and so forth, generally speaking, the margins for groceries are much lower than they are for general merchandise.
That's right.
And so if you can talk a little bit more about what you think about the margins for the general merchandise business, because is it something that you're trying to expand upon more than you are your food margins?
Yeah, great question, Peter.
Portion?
Yep. We would love for general merchandise to be a larger percentage of our business. It's interesting to think about our founding as a general merchandise company. And then with the introduction of the Supercenter, we introduced grocery, and now grocery is larger than general merchandise. So this is an internal point of, I would say, more philosophical and strategic friction that's healthy. You want the proximity and the frequency that having a highly dense network of grocery stores affords you, because that effectively encourages the customer to visit every week. That's what consumables offers. But general merchandise offers the profit power within the basket. So we don't have a challenge with customers, or we don't have a challenge with visits. We have the biggest challenge is in converting somebody from a grocery customer into a general merchandise customer. And part of that comes down to assortment. We need to have what customers are looking for when it comes to general merchandise. And we've historically had a very grocery-like mindset in general merchandise. We call it stack 'em high, let 'em fly. We can sell more t-shirts at $5 than you can count across 50 other retailers. But that doesn't give us any sort of distinct fashion point of view. And so if we're trying to earn more capacity of wallet share, meaning we know the customer is out spending that $50 away from us, where are they spending it? They're spending it at Target, Old Navy, Kohl's, maybe JCPenney still, maybe a little bit on Amazon. And what they're buying in those environments away from us are things that we should be able to sell. And so some of the strategic changes we've made in our assortment in stores has been to bring in those goods that we know that they're buying away from us. And a lot of that comes through strategic analytics and data, data that's outside of our system. So credit card data and panel-based data, survey data, feedback data. We're starting to see some improvement in those areas, but home and apparel are two really big trust categories. It'd be pretty difficult for us to bring in the high income customer into Walmart that's buying their groceries and to say, hey, we think you should also buy your jeans and your jackets and your sneakers from Walmart. That's too far of a leap. So we work on a customer journey that's more natural. We introduce basics. We introduce basics at frequency, maybe some kids-oriented product if it's a family. So we start building trust with mom. And then eventually we start seeing her play within some of our fashion categories. And that might be through our marketplace or through our first party inventory, but it's not an easy thing for us. And again, back to that investment in stores, our customers' perception of our online experience is determined based on what they think about our stores. Our customers' perception of our stores is based on what they perceive online. And so if there's a disconnect between those two, we also notice that customers kind of back away. and don't purchase within general merchandise. But it's really important for us as we think about improving our gross margin mix. We call it merchandise mix. General merchandise has substantially higher margins than grocery and consumables. Double-digit spreads.
And as a follow-up to that, had in the past you been the low-cost leader or tried to be the low-cost leader in the general merchandise space?
We have, but again, I think what we've done more recently that's a bit more prolific is a couple of things. One, we've really embraced this concept of the dupe culture. We want to be able to bring fashion aesthetic that we know our customers desire to own, but they can't afford. So if you think about brands like Lululemon or Free People or others that have an average price point of $140 to $180, that's too high for our customer. So we take fashion inspiration from those kinds of brands and we translate it down into a $25 solution. So that's one area where we're seeing some really strong success. And then you reinforce that through the use of new marketing channels like influencers. It was only 9 months ago that Walmart started using influencers for its own product. So we pay for influencers, we give them cash, and we say, go in and buy merchandise from Walmart and style it in your home, style it on your body, show us that you can effectively create something that looks more expensive for a discounted price. And again, I wouldn't say we're certainly not a pioneer. I mean, the Target's been using influencers, I think, for 12 or 13 years. Old Navy's been using them for 9 or 10 years. So we are very late to that party. But again, it's a little bit more of a modern sensibility. It starts with talent. We brought in a whole new marketing group that has a much more modern sensibility. And then we've hired key talent in certain areas of our merchandising categories to ensure that we're going after the right kinds of goods that we know our customer is spending on, but they've been spending away from us. And we are gaining share for the first time, I think, in 7 or 8 years in home and apparel. So pretty exciting for us.
Once you have that customer, that new customer in that higher margin business, especially apparel, for example, or anything else that you mentioned, how do you retain that new customer? Is there something different than what you've been doing in the past?
So this is something that, because I was on Wall Street as a sell-side analyst for 20 years before joining Walmart a year ago in IR. And this was the thing that has been the biggest aha for me, is that I would have thought it was all about some of the intricacies of, designing into the future products or discrete digital innovation. At the end of the day, retention comes down to 2 things, which is ironic. Well, one of the things is we call a perfect order, meaning I got exactly what I ordered, no substitutions, when I wanted it delivered, not early, on time. So on time and in full. That has a stronger than 0.9 correlation to retention. So hard learning, don't deliver early, especially if it's ice cream and groceries sitting at the front door, right? On time in full, or what we call perfect order, is the number one rationale for retention. The second is equating that into a store experience being in stock. I went with my grocery list and I had 11 items and 4 of them were out of stock. Doesn't mean I'm not going to buy those 4 items. It means I'm getting in my car and driving to the other grocery store and buying those 4 items. So that is lost business for us. We see retention of physical traffic and basket structures being highest when we can fill an entire order or an entire cart. And so when we can fill out the full list, single highest driver of physical retention. It seems so simple. Just have what they want when they want it.
And you mentioned something else that made me curious. You talked about not early, and obviously ice cream being early is a problem. I saw that a couple doors down from me. Mm-hmm. But what about what about electronics or something else that you're delivering being early? Is that you're excluding that? You're not talking about that part.
We have learned the hard lesson that when someone chooses a delivery window of 1 to 2, if you show up at 12:30 or 2:30, you get a 1-star review. Mm-hmm. Yeah. So there is definitely an expectation of when the customer signals a desire, our job is to meet that demand, not to bend for what works best for us. So there are definitely some ways in which we're working hard to build efficiency. Otherwise, you're just going to be running all over the place all the time. but it is on time in full. And every week, Monday mornings at 10 o'clock and Fridays at noon, we go through our customer experience scores. We go through our perfect order measures. It is a $611 billion business with fun, Monday morning, Friday midday decision making. It's highly tactical.
Neat. Let me ask some other, or let some other folks ask some questions now.
Yeah.
And then we will wrap this up at 3:10 to 3:11, so we can get a chance to talk about some of the other items we need to discuss.
Sounds good.
4:10 your time, so you can get home and do
Thank
some
you.
trick treating.
Yeah, you have us for 3 or 4 more minutes. We're here to answer your questions, and after this, you're gonna have to chase us down. So can't guarantee the ability to ask after this. I don't know, Peter, if that's a sign of utter confusion or full and complete satisfaction. Maybe we.
It's a lot of information about the biggest company, the biggest revenue company in the world. So
It is.
Understand.
And we get
and we're
it.
going to have an opportunity to ask you some questions in writing. And right now my target is around December 16th. We would have those questions to you.
Okay.
And if we can get or December 12th, actually, if we can get the questions answered by around December 30th or so,
Yep.
and you and I will talk more about how that works and what your schedule looks like.
That sounds great. Yep.
Those-
Good time for us.
Okay, good.
So
Excellent.
not a question, but a comment. I would just say, Steph, that was one of the most informative descriptions of a company that I've seen in a long time doing this. So that's great.
Thank you, Phil. I appreciate it.
And by the way,
agree. Thank you very much.
You bet.
does there is a former alumni from the University of Wyoming, John List. Is he still?
Yes, he's our behavioral economist. I was just going back and forth over email with him this morning.
So I'm assuming some of the changes you're making are a result of some of the research that he's done. So
Absolutely.
pretty cool.
Talk about a highly, highly educated and informed individual who loves to dig around in data.
Yeah.
Yes. So he's, Mr. List is a professor as well in Chicago, and he is helping us marry up our customer data with economic indicator data, behavioral indicator data to say, can we actually make sense of what's happening in the world a bit through the lens of our customer data? And we're finding some really interesting signals, I will say.
That's great.
Yeah.
Well,
Well, thank you for mentioning his name. I'll let him know that you asked.
Oh, thank you.
Yeah.
Appreciate it.
All right. Thanks, everybody. Well, best of luck. And if you have any questions in the interim, please work with Peter or Jeremy as well. Jeremy's a longtime friend, a client, and now hopefully a shareholder. But we're happy to answer any questions that we can within the boundaries of the rules. So thank you, everybody, and have a great day and happy Halloween. Celebrate well.
Thank you. Take care, Kirsten, Steph. Have a great day. All right, now it's my turn to share a little bit. So I'll share a screen that talks a little bit about our schedule so you can see what we're looking at. And in the next 2 weeks, you'll be able to register for the competition. And I'll be providing some information on how to register in just a little bit. So you have a deadline, a hard deadline for all of your students to register. And you have that as November 14th, which is 2 weeks after today. That's our final date. And well, I guess I realized I put in a November 16th earnings call. Ignore that part of it. Let's jump on down to some of our other parts of our schedule. Oh, I'm sorry. Now I shouldn't jump up for that. November 16th is the earnings call for Walmart. So be ready for that. And you'll be able to follow along. You can also listen to past ones. Going to Walmart Investor Relations or stock.walmart.com is really a good resource for everybody. Your questions will be due. You'll all have an opportunity to ask 5 questions. And as a team, You can put together those 5 questions. You'll send those to me, and we will then get the response from the corporation around December 30th. And then in the month of December, you'll also receive a mentor for your team. Every team will have a mentor who is a CFA charter holder or a CFA member who is is in the investment world, and each team will have one mentor. You can work with your mentor and talk about your questions. You can also work with your mentor and talk about the report, which will be due. We're probably going to do a classic format, so let's highlight that. February 2nd is our most likely date for our report due, and that'll depend primarily on how many teams we have involved in the competition. If we have a lot of teams, we might have to do a staggered format, but for right now, let's assume that we're going to do a classic format, which is that every team does the report and every team does the final competition, and your score is 50% report and 50% final competition, or written, I should say. The oral or the presentation is the final competition. We will have 2 weekends to score our written reports. We'll have a team of scorers, and then we'll announce the report winners around February 6th if we have staggered, or a little bit later if we have. We actually will not announce the report winners if we have a classic format. By the way, there will be another Walmart earnings call right around the middle of February. And right after that final call is the competition date. We are tentatively going for February 28th, but it's possible that we might go February 20th, 21st, or February 26th, 28th for our actual final competition. And we'll let you know about those dates later on. Any questions about the schedule at this point? Feel free to jump in. And then we'll talk about team formation. The rules are available. I won't dive into the entire rule setup, but I would really recommend that you strive for diversity when you're considering your team members. It's not called out as a part of your grading, but it is great to see teams up there who represent diverse views. It should be a team of undergraduate, graduate, or a combination of undergraduate and graduate students, and probably seniors and graduate students are some of the most commonly represented participants. And that's because this competition is a one and done. So if you do it as a sophomore or junior, certainly welcome to do that, but you will also find that you won't have that opportunity to do it later in your career. So as you're considering your team members or potential team members, drawing on friends at school, try to go for those graduate students and seniors. Also, try to go for team members that are going to be in school for the entire second semester. That's because once somebody is at work is going to trump school every time, because that's I would say the highest and best use of your time is to do your work at work and not participate in a competition. This is very important, but you should make some money as well. So try to keep your team members or your team steady in school, actually, for that entire period. So focus on finding team members that are going to be around for that time. You can have no fewer than 3 and no more than 5 members at the time of the local kickoff. So that's right now over the next couple of weeks. So 3 to 5. That's why you'll need to find those 3 members for your team. And up to 5 is fine. You can't have alternates. We'll talk more if you have any particular questions about what happens if you lose a member, but you can replace your member. And if you do have a member who is replaced before the written report is done, great. If that is done after the written report, or actually 2 weeks prior to the written report, then you can continue to compete, but you just won't have those additional members or those replacement members. A little bit about registration. You will have some links. I'll provide all that information to you. You don't have to memorize any of this, but I'll provide it to you. You will have access to a Refinitive's workspace. So whatever team you have Refinitiv. You might also have Bloomberg or other options available to you. And not only do you have to register, but also your faculty advisors have to register. The industry mentors do not, but we will we'll give them a separate deadline later on. All right, and then the amount of time spent, and you might have seen some of these, some of the websites or some information before about the research challenge. 100 to 150 hours is common for the preparation for the written report. So this is a really intense competition. This is not something that you'll do lightly. Prepare for that. Allow yourself the time. It's a great process. It's well worth it. So I highly recommend that you do put your all into it, and you get great results at the end. Some of the results are not just head knowledge about what you get from school, but also you're getting presentation skills that go that dig into what you already do in your presentation skills in school or in clubs or elsewhere in the university, and that go ask for even possibly if you to dig even deeper. So those presentation skills certainly pay off. You will have the opportunity to be able to talk about yourself in your future interviews for work. You will find that the skills, the confidence that you develop over this process of just being in front of other students from other universities, other professionals, CFA professionals at the final competition, interacting with your industry mentor, and certainly interacting with your faculty advisor as well. Those are very valuable, and you'll find that when it comes to the final result for you for your potential career, you will have some additional people interested in you, and you'll actually see them. They'll see you at the final competition. So I think that's part of one of the best parts of it. Steph alluded to it, but she's hoping to get somebody from the ownership or executive team of the Broncos at the final as well, which will be in Denver. And every team should be on an equal playing field in terms of the final competition, because you'll all be coming in. You'll all have the opportunity to stay a night at a hotel paid for the night before the competition. That's for every team, no matter where you live. And if you need additional travel assistance, let us know. We can work with that as well. So those are some of the details. What questions do you have about the competition itself? Most of your professors have seen this multiple times, and so they can ask or they can answer questions as well for you. And I'm also going to be able to, I'll send you my direct information. Let me give it to you just right now, actually, as though I can't type on this one, but let me stop this share. And I'll start another one here in a second. And then I'll just give you my email address, so you can just write it down. And get in touch with me directly if you have any questions. Yeah, feel free to reach out to me directly. Any questions? We want to wrap this up at 3:30, so I'll let you go here. And we are recording this entire thing, so I'm going to go ahead and stop the recording as soon as we stop. As soon as I stop speaking, and I'll get this out to your professors. All right.
Right. Thank you, Peter.
Absolutely. Thank you all. I'm glad to see everybody here. I think it's going to be a great competition this year.
Thanks, Peter.
Thank you, Philip. See you, Rick. See you, Cliff. Have a great day.